What is up, boys? Welcome to another episode of the Marky Maker series. And if you guys can see, I just got my eyebrows threaded. Looks like I got some makeup above my eyelids. But wedding's coming up, so I gotta make sure I'm looking nice and presentable, for my wife, for the people. But in the last episode, I was just going over what we covered. In the last episode of the Marky Maker series, I went over specific psychological areas where you tend to make those mistakes, right? Because it's one thing to say, oh, don't overtrade, don't get emotional after you lose, don't revenge trade, or don't increase your lot size. But it's another thing to actually go into the charts and see those specific situations where it actually causes you to do that. For example, marrying your bias. For example, entering a trade, going break even, it taking you out and continuing higher. Being able to understand these situations helped me so much with my profitability because I knew when to expect that, oh, it might take me out one more time, or oh, it's still valid to re-enter here, rather than just stepping away and then watching it play out without me in the trade itself. But in this episode, we're going to go into the breaker block and specifically one of the strategies combining a ICT concept and time with a specific pair. And that's how you make a model that actually allows you to produce a profitable system. Because trading isn't all just about yourself. While that's a big key component of whether you're going to be profitable, it's also about producing a system that allows you to take you out of the picture. Because when you are in the picture, that's where you leave room for emotional mistakes. That's where you leave room for all this over trading, over leveraging. But when you produce a profitable system, you can stick to it. That's going to help you stay profitable. That's going to help you stay consistent. So with that being said, let's hop straight into the charts and let me teach you about breaker blocks. All right, boys, first things first, I want you guys to know that I'm not going to teach you the way that ICT teaches in his mentorship. Now, I watched his 2022 and 2023 series. That's as far as I got in ICT, but at that point, I already knew enough to take it and apply it into my own trading system. And this is what ICT himself teaches. It's like you don't need to use every single concept. Throughout this bootcamp, I'm going to cover everything. And the reason why is because that's the same thing that ICT did. But the same thing that he says over and over again is like, you don't need every concept. Every concept isn't going to make you profitable. In fact, learning everything is only going to make it more difficult for yourself. Because if you learn everything, it's going to take you a longer amount of time to piece it all together in a way where you can adapt it. Like, I know everything based off of what he taught. Breaker blocks, order blocks, fair value gaps, IFEGs, liquidity, premium discount. I know all of these things, and yet I know how to adapt it into certain scenarios where I'm not looking for a premium and discount in this scenario. I'm not looking for an IFEG in this scenario. And that's what you guys have to learn. You have to learn how to adapt it. And that's going to take you longer if you decide to learn everything. But what you guys should do is figure out what your trading style is and then choose the concepts that align with that specific trading style. Whether you're a swing trader or scalper, whether you like trading Asia session, New York session, what pair you like to trade, what characteristics are included in that pair that you're trading. So pay attention, guys. Learn the concept that you like best, that works best for you, and then master that specific concept, build a model out of it. So the one that I'm going to specifically be teaching you here today is called the breaker block. So let me just make sure that I'm not in the way here with my camera. So the breaker block is going to be something like this. So it's going to create a high. It's very simple to memorize once you get these points. So it's a high, a lower low, and a higher high. So when you get a high, lower low, higher high. So what you're expecting from this after the lower low is it pretty much rejects off of this high and creates a higher high after a lower low. So it goes like this: high, lower low, higher high. And then for the opposite, which would be a sell, it would be a low, a higher high, and then a lower low. And the breaker block is known as this last candle. So in a bearish scenario, it's the lowest bearish candle. That's the one that you're using. So if there's a candle with a wick that's longer than the other candles around it, this is the one that you're going to be using for a bearish breaker block. In a bullish breaker block, you're going to be using the highest bullish candle of the move. And I'm going to argue this is the only ICT concept that aligns kind of with support and resistance. And after learning this concept, I was like, okay, I really just don't like support and resistance in general, even though that breaker blocks get respected like this. And it does still help you be more precise with which candles you use for this support and resistance looking pattern. The way that I structured my strategy around the breaker block was, first of all, I chose a specific time frame. And the specific time frame that I chose for my model was 30 minutes. So for everybody that's been with me for a long time, that has tuned into my streams, you guys know during Asia session, this was my bread and butter setup. It's 30-minute time frame. If I get a 30-minute FVG and then it gets flipped, I look for this breaker block pattern. And what it would be is I wait for a lower low, and as it starts running up, instead of waiting for it to get all the way to the top so that I can use this breaker block formation, I made my own breaker block model, which is instead of waiting for it to bounce off at the top, what I would do is I'd wait for the IFEG to form, because if my narrative is bullish, I'm already anticipating that after a lower low, it's going to create a higher high. So I can take the trade earlier off of an IFEG, and therefore I wouldn't have to wait for this tap at the top, potentially actually catching the liquidity sweep and getting taken out. Instead, I would enter at the IFEG inside of the breaker block. So knowing the breaker block in itself is a very valuable concept, because it helps you understand how the market works. Because normally everybody is taught about trend lines. That's the first beginner mistake, is trend lines. Now trend lines, it's not like they don't work. It's just the fact that trend lines make you think about liquidity the wrong way. And the reason why I say that this is a incorrect and beginner level teaching is because it's so surface level, that there's no precision or anything to the trend line. And you don't actually understand where it's moving, why it's consolidating in this specific area. And then it also teaches you that you should expect it to bounce off of the highs and then bounce off of the lows, right? That's what a trend is. That's what it teaches you. And oftentimes people mistake that, especially in a breaker block, where they expect it to bounce off of the highs and go back to the lows before going higher. And the breaker block is that one formation where it now shows you, it's a signal that it's going to continue going higher. Right, guys? So when you expect that lower low, like for example, we're in a trend, we get a lower low, then you're going to get the higher high. That's what we look for inside of a breaker block. We look for the lower low and then the higher high, right? But instead of looking for the high there, same with supply and demand. They teach you to look at the highs and the lows, and if it closes above, then you're looking for higher highs. But supply and demand is also pretty faulty, because it teaches you based off of where it's accumulating over and over again. And this is where in ICT, I found out that this was faulted a little bit, because these supply and demand zones, they wouldn't necessarily work like the way that they were taught. Instead, what I learned about was liquidity. And liquidity was when highs are taken, then it typically reverses from these highs and starts heading towards the lows. So this is a high that was taken right here. This high was taken, it started reversing from there, and then it targeted the lows, right? So that's how it actually works. And so breaker blocks are kind of like knowing specifically when this happens. Instead of looking for that breakout towards buy side and continuation, you're looking for a liquidity sweep. Whenever you get this liquidity sweep and you know that the narrative is bearish, then you're looking for the breaker block towards sells. Right? So if the narrative is bearish and you get a sweep of liquidity, what you should be doing next is, for my specific model, it would be on the 30-minute time frame. If I got a 30-minute gap that pushed up like this, so during this move that pushed up, we created a gap right here. It took out the highs and then starts reversing on this gap. This gap gets flipped into a bearish 30-minute IFEG. That right there was my bread and butter setup that I would use every single day during Asia session. Right there, it taps back into the 30-minute IFEG and continues lower. So instead of waiting for it to tap into the low right there where it already takes out liquidity, I would enter earlier, already be break even by the time it sweeps, risk free. So that in the case that this is just another liquidity sweep, it goes up before continuing down, I'm risk free. But when you're entering off of the breaker block itself, I never liked this, because I knew that where there are lows, there's also liquidity, there's also stops. So it makes it incredibly difficult to try to trade off of the breaker block low, because that's also where it sweeps out liquidity and tends to reverse. So let's try to look for a breaker block in the real life scenario in the markets. All right, boys, here's a good example from this trading week where we had a nice high, which was this bullish candle right here. Remember, in a bullish breaker block, you're using the body of the bullish candle, the highest bullish candle of this move. So it created the high, then it created a lower low, and then we're expecting a higher high. So you look at this bullish candle, and this bullish candle would be our breaker block, right? But here's where I came in and understood that even above highs, there's liquidity. So that means when we're running up above highs, we still tend to get a reversal because it's taking out so much stop losses right here. So it's risky to try to enter off of the high or even the breaker block right here. So what I did instead is I came up with a model that worked for me, that allowed me to get better entries. And I combined breaker blocks instead of looking specifically at the highest candle. Now this one's a pretty big candle. Usually it's a smaller candle where you have a smaller bullish candle at the top of the move, and it makes it a little harder to get that perfect entry. But if you guys see right here, we also had a IFEG. So this IFG was on the 30-minute time frame. On the 30-minute time frame right now, if you look at the top left, we're on the 30-minute time frame. This right here is a bullish IFG. So bullish IFG on the 30-minute time frame. You can see here we got this move as it ran down to take liquidity. We got a 30-minute gap that formed on this push down. Then when it starts to reverse and it closes above this gap, this becomes an IFG. And this is my bread and butter setup right here. On the 30-minute time frame, when we get this, you wait for it to come tap back into this IFG, and there you can see you would have got the entry inside of the wick. This is how you make your entry so much more precise with the breaker block, and it rather helps you understand market structure. Market structure would be lower low, higher high, right? So high, lower low, higher high. Now let me show you guys one more example, which would be the bearish breaker block, and show you guys how I would have taken the trade from a IFG. All right guys, here's another scenario of a bearish breaker block. So you can see right here we got a low. Now this one had 3 bearish candles. Again, you would use the lowest bearish candle for a bearish breaker block. So it would be this one right here. You mark it out to the right, make that a bearish breaker block, and you wait for it to go and close down below it, tap back in and go lower, right? So we did get that here. But here again, where I look for the trade. So instead, I wait for this low to get created. Now you're not looking at this high to get taken, right? You're just looking for the high above this bearish move right here. So above this bearish move, if it comes up above this, now you just wait for it to come pull back below and then go lower, right? So this right here is our bearish breaker block. But here's where I would make my own model out of this. Again, I'm on the 30-minute time frame. I look for these specific trades during Asia session, and that's typically when we get these moves, right? We get the start of the day where we run in the opposite direction. We create this fair value gap running in the opposite direction, and then when we go and reverse on those fair value gaps, that's where I look for the trade. So here we have a bullish FVG, right? Again, this is on the 30-minute time frame, and only if I got it on the 30-minute time frame would I look for this model, because otherwise there probably just wasn't enough volume, not enough volatility during Asia session. So I would rather not trade than take a trade off of a lower time frame confluence. You can see here we got this bullish gap on the way up. Now, even though we penetrated this breaker block and on the lower time frame you might have wanted to take the trade, I would have only been paying attention to this IFVG here, because again, I just don't like this support and resistance style of trading, and FVGs make so much more sense to me. We simply close below them, we come back up into it, and we get our entry right here. So I would be entering right here inside of this FVG. Even if it was right here at the bottom, I'd still get a much better entry than this last bearish candle in the breaker block. Now, if you were to enter right there, potentially you would have gotten a good entry, but I highly doubt you would have actually been waiting for this candle close. You probably would have gotten impatient when it wicked down below it right here. You would have tried to look for it when it comes back up into it, and you would have gotten cooked. Now for me, I always look for the IFVG inside of the move. It gives me a better position for my entry, and it also just makes it more understandable, more precise for me. So you can see we got the IFVG, we created the breaker block range where we got a higher high and we're going back down to create a lower low. We got the IFVG entry and we ran down, absolutely melting through this entire range. So that right there is a scenario of a bearish breaker block. Now again guys, I only trade gold, so I'm showing you guys all these examples on gold. If you guys also want to learn how to trade gold, gold is actually quite nice. It respects the ICT confluences really nicely as long as you're trading during the right session and you're looking for the right model. That right there is a video on IFVGs. I hope you guys enjoyed it and learned how I used another confluence that I learned from ICT, paired it with the structure that you learned from the breaker block, and I made my own model that I can trade every single day during Asia session. If you guys want to apply this into Asia session, you want to see how I do it, feel free to join me every single day. I go live at 7 p.m. Pacific Standard Time. The link to my Telegram is going to be the first link in the description. So if you guys join that link, you're going to be able to get the links to my streams. They're free and every single day during Asia session. Thank you guys for getting through episode 4 of the Market Maker series on breaker blocks. With that being said, I'll catch you guys in the next one.